Hi, everybody. Good afternoon. This is Vicky Pizzarelli with Engel and Volkers. You're at Coffee Talk with Vicky Pizzarelli, and I have none other than John Belmore, sales manager of Embrace Home Loans, with me, and he's here to continue our discussion for your working towards home ownership for 2023. So let's recap a little bit what we spoke about first. How from last week's video we spoke about how you should prepare to get towards home ownership. And I'm going to take you through the steps of questions that probably most people have. And I know one of the big questions is credit. I think a lot of people assume that they can't buy a home because their credit's not good, or they're going to Credit Karma. And it's a whole way of looking at it that you really need to talk to a mortgage professional like John. And John, take the floor. Tell us a little bit about yourself for people that don't know about you. And let's talk about credit and get down into it.
Sure, absolutely. So yes, I'm the sales manager at Embrace Home Loans. We're over on Main Street in East Greenwich, down the street from Vicky's office. I've been with the company for going on 8 years now, and I run a small team out of Embrace's retail branch. And Embrace, if you're not familiar, is over in Middletown. Been here for almost 40 years. So national lender with a really good local touch. And we're owned by one person. So we're a direct lender. It's a little bit different than, your banks or your thousands of employee companies out there. So that's a little bit about me. But yeah, Vicky, so last time, we kind of segued into beginner stages of, how to get prepared for home ownership resolutions for 2023. We're starting in the beginning. We're going to go over credit right now. It's one of the biggest things. So in terms of what you need to know, let me just kind of present my screen here.
And I also want to let anybody know, if you have any questions, please type them in the chat. If we're unable to get to your questions, sometimes we get a little intense with talking. We might miss a comment. So just know that we'll get to any of your questions. Just put whatever questions you want in the chat, and we'll get to use as soon as we're able to.
Absolutely. So this is essentially everything that I could think of for, we could fit into 30 minutes anyway, about what you need to know for credit scores. So Vicky, if you can present my screen there.
Here. Okay, you have to do it.
Oh. I'm sharing.
Hit the present button on the bottom.
Yeah, present. Oh, you want to know what I'm doing? Yeah, so share screen and screen to share. You see it?
We're having a little technical difficulty here. All right, here we go.
There it is. Perfect.
Okay, there we go.
All right, so everything that you need to know about credit. This is as much as I could pack into 30 minutes. So essentially, credit is a representation of your worthiness to borrow money. So there are many, many hundreds of different types of credit scores. The two main ones are FICO, which is the Fair Isaac Company, and Vantage. And Vantage is, TransUnion, Equifax, and Experian came together and created their own credit scores. 80% of lenders use a FICO score. There are different FICO models depending on what you're trying to buy. So a credit card FICO score is different than an auto loan, which is different than a mortgage. And so it's very important to know the differences between them. So a FICO score at its core is a number somewhere between 300 and 850, which determines risk from a lender's perspective or your credit worthiness. So as a buyer or a home applicant, right? So it impacts your options, your interest rates. You can think about insurance premiums, rental applications for, renting a house versus buying, cell phone plans, auto loans, credit cards. It goes well beyond the mortgage world. At its most basic core, it essentially just helps determine your dependability and if you're likely to, repay the loan that they're going to give you. If we go a little bit further, we can kind of break down on how it's calculated. So the biggest thing is payment history. 35% of your score, at least with your FICO score, is payment history. Utilization of credit, which would be, let's say you have a credit card that has a $1,000 limit to it. Your utilization is going to be a percentage of your credit score. So if you're using $500 of that $1,000 limit, your utilization is 50%. That amount is going to be 30% of your overall score. So you can kind of see how it gets really granular. Generally, with utilization, they want to see you use less than 30%. As you start utilizing all your credit, it essentially tells them or shows them that you're not very good, good with money, I guess, for the lack of a better term. So a lot of questions that my clients ask me, very quickly, how do I help raise my credit score? One of the things is increase that limit, if they can, especially if you're starting out with credit. Most credit card companies will give you either a secured credit card, which is you give them $200 or $500 in cash, and then you borrow against that and pay it back. So that's a quick way to build your credit. If you are not in the secured credit card world, then that utilization may impact you more. So that $1,000 could become, let's say $500, or I've even seen $200 limits. You can go get gas and spend $100, and then now you're already at 50% of your limit. Go grocery shopping and you put it on the credit card. You know what I mean? It's just, it adds up. Right. Yeah, exactly. Yeah, exactly. So, that's kind of the first thing I look at when I'm looking at somebody's credit score and their full report. It tells me what their limits are. Try to increase the limit, just so that if you do make that, $100 or $200 pay, expense, obviously you want to pay it back, but it doesn't impact your utilization as much, right? You could imagine if that, $500 or $1,000 limit is $2,000 or $5,000. Putting $50 or $100 on that credit card is not going to affect you very much. So you won't see these credit swings that we see all the time. The next thing is length of credit history. I get clients ask me all the time, I haven't used this card, I'm going to close it out. Don't do that, because let's say you opened a credit card when you were in college. You got, I got walked up, or, you go to a football game, right? And you have Discover card there. Hey, sign up for this student credit card, right? Unless there is some sort of a annual fee, or, you really can't help but use it, I would simply keep it open, and maybe put one sort of recurring expense on it and have it under auto pay. So you're still utilizing the card. You're still getting your payment history, but if it was open 10, 15 years ago, then you have that very long credit history that's averaged with all your other types of credit. So if you have two credit cards, one was open 15 years ago and one was open last year, if you close that one that was 15 years ago, now 15% of your credit score is impacted by that, because it looks like you're brand new to credit. So, it's a game, unfortunately, and it's a shadowy game too, because not a lot of information is provided to you when it comes to calculating these scores.
No, I agree. I mean, I think this is really a great segment to speak about, because I know there's a lot of questions about it. And that's where you really have to start for obtaining a mortgage.
Yeah.
And what do you say about, like, when people have they have charge-offs, or like collections that, like, things have been charged off? I get buyers that will say, "Oh, I'm going to go pay this all off." What do you? I mean, I know what you're going to say, but what would you tell a buyer about doing that?
So it depends. Charge-off accounts, generally we can ignore, because when you do a charge-off, 9 times out of 10, they're going to send you a 1099-C, which is a cancellation of debt, and you have to pay your tax on that cancellation. So essentially, the person who lent you that money has forgotten, or gave up hope of getting that money back. So they write it off as a loss on their side, and then they send you that 1099-C form. So if, sometimes it still remains on credit. If you have that letter and it's still on credit, utilize it to say, hey, listen, this is gone, get it off my account. If you don't have that letter, and it's just kind of sitting there, you can dispute it, but then you get into disputes are not, always a good thing as well. If you have more than, on average or in general, about $10,000 worth of disputes on the account, they're going to have you deal with that in some fashion or the other. So, collection accounts, If they're medical collections, those are rampant in the industry right now. We generally don't count those, for anything. They're still on your report and they're affecting your score. But from a mortgage perspective, we essentially just count it as a zero when it comes to monthly debt and that sort of thing. So I would get these things taken care of, but it really, I guess, the long and short of it is it depends. I'd even seen it where, collection accounts are old and they'll eventually drop off. If you start poking the bear, they can reactivate the collection and now your time starts all over again, or they switch it from one company to the other. So it really depends on how much it's affecting your credit score, I guess would be the answer to that question.
Right. And I know that's a big question for a lot of home buyers. And sometimes I always say, don't do anything until you speak to a mortgage professional, let them look at your whole credit history and kind of figure out what you should do. So like really don't make decisions unless you speak to somebody that knows what they're speaking about.
And full disclosure, I am not a credit expert in any sense of the word, but I've been looking at these credit reports for, going on 8 years now. They change their algorithms all the time. They change the style. They change how much things are affecting your score. So if there's something that I can't help you figure out, there's two avenues. We can do what's called a rapid rescore. We have a system where we can do simulations for you, and it'll actually give you a checklist. I need to increase my credit score by 50 points within 60 days, right? That's the parameters. And I have $5,000 to help me get to that position. It'll say, do this, that, and the other. And then you can, it'll give you a range of how to get there. When you do those things, we'll do a rapid rescore, which is essentially forcing the credit bureaus using documentation to rescore you. Normally, credit scores are calculated every 30 days and you have to wait. And one of the reasons why you have, many different or varying credit scores is because they all get different information at different times. They use different algorithms to process a score. And so that's why it's not like there's one score you have. It's
amazing.
It's crazy. So if we can't help, then, certainly we would do some sort of a credit repair, which is very different, than people have gotten into really big trouble as far as not paying credit cards and try to negotiate debt and that sort of thing. We strongly advise not to do that. But credit repair companies, as long as they're vetted and you have a reference, I think they're pretty good and helpful.
No, it can be very confusing. That's why I'm glad we're doing this segment, because it is the first step you have to take towards home ownership. You have to make sure your credit's good so you can get a good mortgage. So this is really a great informative seminar. We're not just
we could do one of those if you want. Yeah, the other thing that a lot of people don't realize is there's 3 main credit bureaus. So like I said before, Equifax, Experian, and TransUnion. And depending on what data they get and how much their information varies or when they get it, you're going to have 3 different scores. And generally mortgage companies don't average your scores. So it's not like, when we say, oh, you have a 760 credit score, it's not an average of the 3. What we'll end up doing is just using the middle score, right? So you can have a 800 with Equifax, but a 675 with Experian, and your TransUnion score ends up in the middle. It can be any combination of those different bureaus, and we just choose the one that's in the middle. So if there's an account that we're trying to target, we can do that as well.
Now, what happens when you go for the mortgage? What does a buyer need to bring to you for you to start this process and obviously to get the credit score going? I know a lot of home buyers will go to NerdWallet, Credit Karma, all these other sites, and they think that's their score. And I know you just explained what you're looking for. If you could just explain to them the difference between those sites and what a mortgage broker would be looking for.
Yeah, I actually have a slide for that here, right here. So Credit Karma uses the Vantage score, but they use Vantage 3.0. So it's not the latest algorithm. It also takes much longer for Credit Karma to get your information. They also only use 2 out of the 3 bureaus. So experience not factored into the score. So it's a really good monitoring tool. I would say the credit scores are fairly accurate, but they are usually 30 to 50 points higher than what your actual FICO score is. Because you have to remember, FICO is there's FICO 3, 4, 5, 8, 9. There's many different FICO models, and it's a secret sauce. They're not going to tell you how your credit is calculated, because then you'd be able to play that game, right? So when you're comparing Credit Karma, which is Vantage 3.0, to FICO 8, which is what most of mortgage lenders use, they're not apples to apples. It's kind of apples to oranges. Yeah, they're a fruit, they're round, that's about the same size. So you're going to get close, but it's not going to be the exact same thing. So the big thing is, it's a great monitoring tool. I would, if you're seeing 726 on Credit Karma, I would pull 30 points off of that and expect your credit score to be, whatever it is, 696.
Yeah, thank you for clarifying that.
Yeah.
So when a buyer is starting the process for a home, and they're getting their credit in order, and they have their car is breaking down, and they have to go buy a car.
Yeah.
How does that affect them?
Don't buy a car when you're in the process. That sort of gets into it's a twofold question, because that gets into utilization of your credit as well. So, if I go back up, so your new credit and inquiries counts as 10% of your score. So the general rule of thumb is, don't apply for any other types of debt, unless you absolutely have to, right? Your car breaks down and, you got to go get a car, you got to do it. It's, we'll try to work around it. Obviously, you want to minimize your expenses and everything. If we pulled your credit during the application and then you have to go get a car, we'll see this new inquiry, and then we're going to have to get statements and everything from you to make sure that you can afford the payments along with the new mortgage. So it gets a little bit more involved. It's not anything that is out of the norm, and stuff like this happens all the time.
Talk to your loan officer before you do anything.
Yeah, exactly. When I send out my initial thing, it's always, don't pull any, don't allow anybody to pull credit unless you talk to me first, right? So we normally get into scenarios where you're buying a house and, you're under contract, and now you're going about, you're buying furniture and, all this other stuff. Don't do that yet, because you haven't signed on the dotted line quite yet.
Yeah, no, and I have to say, I've had that where I was at a home inspection, and my 2 buyers were coming to the home inspection, both in brand new Lexuses with the dealer plates on. Guess what? They didn't get the home. We had to call up the home inspection. I called the lender right there. He says they took out car loans. They're not getting the mortgage. So just be careful, guys. Don't, I know you're excited. You want to go do all this stuff. You could, buy furniture for your house. Just buy the house first and then move on to the next thing.
If you absolutely have to, just let us know, because I'll be able to pull all your debts in. I'll add the fake new car loan, and I'll say, okay, your DTI is still good, So, from that point, credit reports from a mortgage world, they last 120 days. So I don't have to pull your credit multiple times through the process. The only thing that the underwriters do is they will pull what's called a UDM. It's undisclosed debt monitoring. It's just like a report. Is there anything new today that wasn't there before? And so if there is a new car loan, or if you applied for a new credit card or whatever, we'll just need the statement to make sure that it fits into your profile as a whole. So we're not going to pull a new credit score. The score will remain the same, but we have to factor that into the DTI.
Yeah, just talk to John before you do anything.
Yeah. Happy to answer any questions, because there's a million different, roads you could drive down to stay on that topic.
And everybody has their own story. I always get buyers that they compare themselves to somebody else that bought a home and did the same thing. And everybody has their own credit history and their own story. It's just different. So you can't compare yourself to somebody else at all.
Not at all. Not at all. So yeah, just stick to the basics, lay low credit wise if you're applying for a home loan. If you're looking to get, realistic expectations and answers on what your credit score is and how it looks, you have to have the initial credit pull, and then we'll be able to kind of guide you essentially from there. As far as building credit, if you don't really know much about it, or your credit is fairly poor, it can take a while depending on what's on it. If there's bankruptcies and foreclosures, those are pretty high on the list of impactful. But if you have stuff like, missed credit card payment here or there, collection account, repossessions, things of that nature, I wouldn't consider them small, but they're easier to handle. So the biggest thing with poor credit is monitor your credit for any sort of discrepancies or errors. You'd be shocked at how many times I see that's not mine, or I didn't remember I was an authorized user on this account. That's one of the big ones. You're an authorized user, which means that, let's say your parents take out a credit card to help you. They have their credit card. They add you as an authorized user on their card to help build your credit. But then something happens to them. Maybe they're not making payments. It's still hitting your credit, and that's your derogatory credit, your missed payments. Get rid of that. So,
I mean, even like people co-sign for a car.
Yeah.
And they don't realize that they're responsible too, and that person's not making payments, and it's affecting them.
Yeah, I've seen it both ways. Parents helping kids or family members, and vice versa. Co-signing in general is risky because you just don't know what the other person is doing. But if you're trying to build credit, it can certainly help you. Somebody who has a 15-year credit history with stellar repayment, if they add you onto one of their credit cards, your credit score can go up rather quickly, So monitor for things that are not correct or bad, and then work with the credit counseling agency in order to help potentially even remove some of these things. And that'll help you greatly.
Yeah. I also, you got some, like, say, first-time home buyers, they don't have any credit.
Yeah.
And that's not necessarily a good thing.
Yeah.
You have, it's funny because you have to be in debt to get that.
Yeah, it's confusing because when my wife and I bought she wasn't my wife at the time, but when we bought our first house, she comes from a family where they use cash for everything, right? Debt is the devil. I don't want it. It's very bad, which I understand to a degree, but you have to leverage debt in order to, get ahead in the world. Unfortunately, if you really want to make, you want to get a car, unless you can afford to buy it cash, you need to have credit. Not a lot of people have 40, 50 grand out there, whatever it costs to buy a car these days, in cash, right? Most people want to move up and, move from renting to home ownership. So you need to be able to qualify for these things. If you're cash only, it's very difficult. The only thing on my wife's credit was a medical collection. It was an x-ray that her mom or dad never paid or whatever. And it was sitting on her account for like 6 years. And so by the time we went to go buy the house, her credit was, there was nothing on it. So there was no history. And so her credit score was poor. So we had to build her up over the years in order to actually get decent, rates and everything.
Yeah, I know. It can be very, it's like playing a game of chess, really.
big time. Big time. I mean, it kind of brings me to the next topic here, so generally speaking, for individuals with a lower credit score, the FHA is the better route to go. They're much more lenient when it comes to helping somebody get a home. So, the FHA will allow you to buy a house down to 500 on your credit score. 300 is the bare minimum. So you're only 200 points off the bottom. Most companies will want you to be at 580 or above, preferably 620, 640. So the FHA is lenient, but you will also pay a lot more using an FHA loan. It's a stricter loan program when it comes to the house that has to qualify. So if there's chipping or peeling paint, if there's anything wrong with heating or cooling systems, like these things have to be taken care of, which we'll get into in a little bit later. But conventional is kind of where I start first because the fees are less. The mortgage insurance eventually can go away. You're trying to qualify for that program on your own per se, whereas the FHA, the VA, these are all government issued loan programs. And so in order to keep them afloat, there are higher fees that go along with them. They're easier to qualify.
Are there normally higher rates than a conventional?
No, usually the FHA and VA are lower, but it's because they have the extra fees. So they have, if you put less than 10% down on an FHA loan, you have lifetime mortgage insurance unless you refinance, right? Mm-hmm. And that could be $200-$300 a month. Plus, they also charge what's called upfront mortgage insurance. which gets added right to the top of your loan. So it's nothing you bring to closing, but it's finance over the life of your loan. So, it just becomes more expensive that way. So that's kind of how they counteract each other a bit. If you're sticking into a house, long term, and you have a 620 or higher, I would probably compare the FHA and see which one is better for you. USDA, I see a mistake here. It's not 540, it's 640. Jumbo loans generally want you to be 700. You're borrowing lots and lots of money. They want you to have a really good credit score. On the other side of FHA, which is a little bit more lenient or lax to qualify, there's what's called non-QM or non-qualified mortgages. So these are allowing you to do, like we used to have a program that you could do one day out of bankruptcy, right? Normally you have to wait 2 or 3 years. But in these cases, these are essentially the credit score minimums. I would say target a 640 or higher if you really want to get decent terms. 700 plus is where you're going to find the best things.
Yeah, because I mean, we all see it when you see different lenders advertising low rates and everything, and it's mortgages, and that rate is buyer specific. It's not everybody's getting the rate they're advertising. It's just a bait and switch. It's a marketing. It's just really good marketing, really.
Yeah, it's so we I don't know who you're looking at. Well, you're supposed to have the qualifications right at the bottom. So
yeah,
the higher the loan size, the more that you're borrowing, usually the score is better. But on the flip side of that, the more you put down, the more qualified you seem. So the credit score, or excuse me, the interest rate can be better. But yeah, when you're looking at these, the rate today is whatever 6.2 or whatever they're saying the rate is, there's no one magical rate for everybody. There's like 23 different factors that go into gathering an interest rate for you. It's your credit score. What are you going to use the house for? Is it going to be, you're living in it, second home, investment property? Is it 1 unit, 2 unit, 3, 4? Is it a townhouse? Is it a condo? Is it a 15 or a 30-year loan? Conventional versus FHA? Is it adjustable? There's a million different factors.
Multifamily, you got to have the funds in your account to subsidize the rents, and then the condo fees. I mean, there's so much involved. I really wouldn't want anybody to assume,
right?
Because they see an ad and they call. We're marketers. We're real estate professionals. That's what we do. That's how.
Well, usually what you're seeing is an average of everybody, right? Yeah. So when they say, "Oh, that's right," yeah, the conventional loan is 6.2, right? So that could be somebody that paid. Let's say we just take 2 people, right? Somebody who paid 3 points, which is just an extra closing cost in order to buy a lower rate, versus somebody who maybe has a slightly lower credit score and qualify with a higher rate. You average those 2 together, that's where you get your 6.2. So, there's not a specific rate, that's the average, but it's based on usually, 40% down and 700 scores. So it's kind of like the, A paper best you can do when they're advertising the rate, because they want it to look good.
And that's another thing you just brought up. I'm going off topic here, but points. I get a lot of questions about points and how much do they cost and does it make a difference? I think there's a lot of confusion what a point is.
So 1 point is 1% of the amount of money you're borrowing. Generally, it will buy your interest rate down 0.25% permanently. So if you're, let's say the rate that you qualify for is 6.25%. If you pay 1 discount point, let's say you're borrowing $300,000, 1 discount point is $3,000. It will buy your rate down 1/4 of a point. So you can calculate your break-even period very easily. And that's, I don't have the numbers in my head because I'm making this up, but let's say it's 4.5 years, right? So at 6.25 versus 5.99 on the rate, let's say it saves you $50, whatever it may be, and it costs you $3,000 to do that. You just do simple math, and 80 months, divide that, whatever number, that's 7 years in order to get you a break-even period. So if you refinance or sell within 7-year period, then you lost money on that deal. So in today's market, most people are not buying down the rate. They're either taking adjustable rate mortgages, which are fixed for the first 5, 7, or 10 years because they offer a lower interest rate because there's higher risk associated with them for you because they can adjust after that initial period. And the plan for most people is to refinance within the next, I would say 12 to 18 months at this point. So to pay a small fee in order to lower your interest rate for a year doesn't really make a whole lot of sense when you're looking at it as a permanent basis. If you want to start off with a lower interest rate, we can discuss buy downs, which are temporary. So these are like a credit that the seller would give you off their sales price in order to help you start with a lower rate. And so, we have a 3-2-1 buy down. So in the first year, your interest rate is 3% less. So let's say your note rate or your rate to qualify is 6.25. We'll start you off at 3.25, and then it's 4, and then it's 5, and then it's 6.25 for the remainder of the term. So that's more beneficial, especially in today's climate where the rates are rather high, because that money doesn't go away. If it's unused, you can apply it towards a refinance, and it's nothing that you've paid extra in order to get that. So that different topic, but it's it's good to know. Yeah, I would advise. Let me just put like a final sentence. I probably wouldn't advise paying points in today's climate because rates are slated to fall. Probably not going to see 2s and 3s again, but 4s and 5s are definitely in our future.
Which is not bad. I always say my first home was 11.8.
Yeah, right. Exactly. If we have 2 minutes.
Yep.
So, we went over the credit score basics. If you have questions about it, because I know that it goes quickly, the conventional versus FHA and VA, I just want to go over this a little bit. Conventional is where I start. FHA is where I fall back to. If you have the lower credit score, usually the FHA is your starter loan, right? It'll get you into the house. And then as you build credit over the years, you can transition to conventional. The conventional is not insured by the government. It's harder to qualify for. They do have minimum down payments of 3%. You don't need to put 20% down. That's a myth. You have mortgage insurance if you put less than 20%, but it's not lifetime like the FHA is. There's first-time home buyer programs, and there's various terms. I would say you want to have a 680, preferably a 700 or higher for conventional. With the FHA, these ones are insured by the government, easier to qualify for the loan, but it's not just you, it's also the house. So, think new construction, think, something that's been completely remodeled. They want it turnkey because they're insuring the loan. They want to make sure it's safe for you. Minimum down payment is 3.5%. There's 2 types of mortgage insurance. So the interest rates are lower. The down payment requirements are lower. They allow you to have a lower score, but you pay for that in terms of upfront mortgage insurance and monthly as well. No income limits on FHA, no geographic restrictions on FHA. But as I mentioned, the appraisals are a little bit stricter. And then VA is kind of the same thing. Great for our veterans, very easy to qualify. There's no minimum credit scores. There's no loan limits. There's no DTI. You definitely want to have a 580 for most lenders. But beyond that, you can qualify for 0 down payment. I would say there's 2 restrictions with the VA or things you want to think of. The VA can end up charging you a funding fee if you're not exempt. So if you don't have some sort of service-connected disability, you can end up paying quite a bit to end up utilizing that loan. So I compare conventional and VA quite often, but you can't beat the 0 down, and there's no mortgage insurance at all. So those are
that's really a great loan, especially for our service people. It's really a good loan. I think a lot of realtors out there, when they see FHA offers with FHA or VA, they like stay away from it, and it's really understand how it works.
Yeah.
And, if you're listing a property, you should know if it's going to qualify or pass the appraisal and inspection for those loans. I mean, that's our job to know that. So you really need to have a real estate agent that's going to know how to work it, really. And
the FHA loans, I do quite a bit of them, not so much over the past few years because the interest rates were so low that it was easier to qualify for conventional, but the FHA loans are a great program. They offer, we can get into so many different things, but there's streamlined refinances. There's no appraisal, no income documentation. So if you start an FHA loan with a high rate and rates fall over the next 12 months, we can do a streamline, get it done in like 10 days, and then you have a lower rate without any cost essentially to you.
That's
It's
right.
a
That's really great.
great loan.
I mean, there's so much to cover on this, and I think you hit all the bullet points on
I
this.
tried to.
We try not to keep these long because everybody, the average person has a short attention span. So, we like to try to get like as much as we can out there. So if anybody has any questions, John's information's up on the screen. We'll have it in the chat, and reach out to him. He can help you. Don't assume you can't buy a house because you think your credit score is not good enough. Let a professional like John look at it and tell you what he thinks. Don't assume. When you assume, there's that expression. You make it, I'm not going to say it online, but
donkey, say a donkey.
I'll get flagged by Facebook. But don't assume you can't buy a home, because there's so many different ways, and there's so many programs out there, and there's down payment assistance, and there's so many avenues and different aspects of buying a home that you really need to speak to a mortgage professional.
Yeah, inquiries are only 10% of your total score. So, you don't want to have 100 inquiries, but you need to have the one, so somebody like myself can look at the credit report and tell you where, you're either great and there's no problem, or where we can adjust and increase your score. So
yeah, and just be careful putting your information online, like going online, getting a mortgage and applying online. Like, talk to a physical person. I've seen a lot of people get into trouble with scams and stuff like that, or they got hacked because they gave their information to somebody that wasn't an actual professional in the industry.
Yeah, the NMLS number is important. Make sure you look at that.
Yeah, just be careful with the internet these days, and everybody has can access. So you can click a link on your phone, they have access to your phone. So just be careful out there, and physically speak to a person, and they'll send you their link to get all the information. So just be careful. And again, John, thank you so much. A lot of great information. Our next coffee talk will be next Wednesday. I'll be broadcasting it, and we're going to be talking about DTI. I know a lot. It's another mortgage term. A lot of people don't understand it. So we hope that a lot of these things are going to bring some information to everybody and help you towards your home ownership goals for 2023. And thank you again. Thank you, everybody, for tuning in, and we'll see you next week.
Excellent. Thanks, Vicki.
Thank you. Bye.
Bye.